Hello everyone, how are you? Hope you are all doing well. This is welcome you all to my channel, Dr. Labib Academy. I am Dr. Labib, coming with a series on the lectures related to ACCA certification program. In this series, we are working with SBR Strategic Business Reporting. Okay. I kindly request you all to subscribe to my channel, share this channel, and watch till the end. If you find really value added, like the channel, and most importantly, post your comments. How best we can improve, how best you want clarification, and how best it can be done in either way. So I kindly request you all to subscribe to this channel, so it will be helpful for us in the examination. This is related to ACCA SBR, okay, and this is 7 by 25. 7, see, this is very important, okay. When we are talking in terms of 7 talks about the series. Is that I will give the sequence number, and according to the sequence number we are going to work it out. Okay. Simultaneous, first we will cover the concept, subsequently parallelly we will do the questions also, so that it will be easy. We are talking about IAS revenue. Okay, we are talking about the, see, till now we have a concept called as IAS 18. Okay, it talks about the revenue. Now IAS 18 have some challenges which has been involved in that, and in order to overcome the challenges, what happened, they have come up with something called as IFRS 15. Okay, IFRS 15 talks in detail about how we have to recognize the revenue. Is it how we have to recognize it, how you have to measure it, and how it has going to be present. Okay, the most important thing is how it has to be recognized and how. In this section, in this session, we are going to cover the concepts, and with the concept we are going to understand its applications. See, that is the most important thing, is it? Now, I will believe, I trust, and this is my understanding. In every way, test your understanding is very important. The moment you understand, you will go cover these things, automatically you are clear about the entire concept. We have to understand the test your understanding in detail, right? We will cover that. Now, what is the difference between why IFRS 15 came? There are so many things has been involved. See, when we are going to generate revenue, we are generating revenue from the different aspects as such. Is that we are generating revenue from products, we are generating revenue from services, is it? We are generating revenue partially, we are generating revenue from the guarantees which you are going to give. And nowadays, when we take this into consideration, most of the businesses have very clear contracts, terms and agreements. Okay, we, as per with terms and agreements, we have terms and conditions, we have to work it out. Yeah? This is what it says. Very easy, very simple, and it makes sense. And revenue is a very the most core important thing that is part of financial statements. What we are doing during this, most probably this chapter will be in two parts. Okay, it will be 7A and 7B. Today we will cover 7A, and in the next session we will cover 7B. It's a very lengthy one. Okay, what we are doing, discuss and apply the criteria. What is there is a criteria, specific criteria. These criteria have 7 steps. 5 steps. Okay, there are 5 steps are involved. Is that they have 5 steps are involved. I'll put like this. It is 5 steps. Okay, These 5 steps you have to fulfill. Then only it can be, we can put as per IFRS 15. Okay, before an entity can apply a revenue recognition model. This is the first point. The second point is we discuss and apply what is the accounting treatment relating to the revenue earned. When you are earning revenue, how it is going to be earned from a contract with the, see, there are different ways. Definitely there will be agreement will be there. There will be agreement with respect to, they say that it is going to be 10%, it is going to be 20%, 30%, 40%. Sometimes it is going to be successful implementation. Is it right? Then only you are eligible. It is not completed, then what are the terms and conditions? That we will do. Apply the criteria of recognizing the recognition of contract cost also. It's not only the contract revenue completion. When you are saying contract cost in terms of percentage of completion. Discuss and apply recognition and measurement of revenue, including what are the things we are going to cover. We are going to cover with respect to performance obligation satisfied over time. The first one. We are talking in terms of sale with the right to return. If we are returning the products, see, it will happen. We are buying the products and we will return. Now the concept is, in some countries still it exists. But in most of the cases, what will happen, whenever you will have the sale, they say very clearly, within 7 days. Is it right? It can be exchanged. Is it? It can be exchanged. Cash will not be returned back. Okay? Means how you have to deal. We are talking in terms of consignment arrangements. Consignment arrangements. We are talking in terms of, we'll talk in terms of warranties. It will take into consideration in terms of dealers also. Variable consideration, how based on the percentage. What is the principal versus agent consideration? And in some cases, non-refundable upfront fees. They say that yes, you have to pay 10%. 10% will be non-refundable. If you are completing the contract, it will be part of that contract. If you are leaving the contract in the middle, then 10%, 20%, 5%, 1% of the amount will not be returned. Is right? This is the basic introduction about this revenue IFRS 15. What we are going to do, there is a 5-step process. This is a very simple. It's a 5-step process to revenue recognition. How we are going to discuss about the contract cost and how it has to be presented in the financial statement. When we talk about financial statements, it talks in terms of income statement, it talks in terms of statement of financial position. Fine. Next, coming back to this, what is the IFRS? See, slowly and steadily first focus on this. IFRS 15 revenue is the income arising in the course of entity normal trading. Is it? When we are talking about the normal trading, it should be from where? It should be from operating activities only. Is it? You will have revenue. When we are talking in terms of revenue will have from 2 different sources. Is it right? We have the revenue from the operating, is it right? From the operating activities, core activity. There is a income, is it right? There will be income from where? There will be income from non-operating. Revenue presented in the final, this is in terms of profit and loss account, and should not include the proceeds from the sale. See, they are making very clearly, should not include proceeds from the sale of non-current assets, and it should not include sales tax. It should not include sales tax. What is the investor's perspective? They are talking about the most important factor considered in assessing financial performance. Oh, see that The old revenue recognition standard IS 18 revenue has heavily criticized for containing principles that are difficult to apply to all. But the most simply this is the one of the reasons why IFRS has been ISRA 15 is being introduced. It has a lot of difficulty to apply to all, but more simply of transaction, and for lacking guidance in many key areas. That the problem has been exaggerated on entities enter into complex transaction. Means definitely it will not be a straightforward transaction. It's not like that you are paying cash and cash is changing from one hand to another hand, and definitely it is going to be treated as a revenue. In most of the cases, what will happen, you will not have cash transaction, you will have credit transaction. In the credit transaction, how the mode of operations should work. Okay, mode of operations should work. For this reason, the board view development of IFRS from revenue from contracts with customers. An extremely important IFRS 15, which was issued in 2014, it provides a very comprehensive and robust recognition model. Okay, this is the reason. This is why the IFRS IS 18 has been come up with another one of IFRS 15. Okay, you will be studied revenue. You have studied in financial in prior studies. Is that we have done in terms of financial reporting also we have done IFRS 15, very introductory one. This is the 5 steps process. Is that we are going to cover this is the only thing that is concerned about. Okay, we will cover the examples accordingly. We will do test your understanding, and each and every concept will be tested, explained and understood. Okay, IFRS 15 from contract with customers say that the entity recognizes revenue by following 5 steps. First, you have to identify that it is a contract. The second, there should be a performance obligation. Okay, there should be a performance obligation, means you have to compensate, you have to match the things which you have been promised. You should have the price, you should have the transaction price to the performance obligation. Allocate the profit. Person means you are doing. That's why I told you have done doing it in phases. 10%, 20%, 30%, and 40%. Then you should allocate the transaction to the performance and recognize revenue when performance obligation is satisfied. Once the performance obligation is satisfied, then only the revenue has to be recognized. The following is that this is where the things will work. One by one we will take into consideration and we will follow it. Okay, on 1st of December, Wade receives an order from the customer for a computer as well as 12 months technical support. Wade delivers the computer and the transaction is legal title to customer on the same day. What it says, the customer paid the amount 420 upfront. It's sold individually. The selling price of the computer is 300 and the technical support is how much? Technical support is 120. Okay, this is what they are saying. They are asking us to apply the 5 stages of revenue recognition. These are the 5 stages that has been mentioned. Is it? Now how the things are working? See how the things are working. They said that this is an agreement between Wade and the customer. First thing, there is an agreement. There are 2 performance. One side we are giving the product. One side we are talking in terms of product. One side we are talking in terms of service. The third is we are having a transaction price. They're saying that the transaction price, allocate the price. We are allocating the price 300 for the product, 120 for the service. Okay. Now see the thing. This is where it matters a lot. Product, we are selling it directly at once. Is it right? Control over the computer has passed to the customer, so full revenue is recognized. But the service is not like that. Service is for how many months? Service is for 12 months, where it has been mentioned. Service is for 12 months. When service is for 12 months, what we have to do? We have charging how much? 120 for the service. Each month you have to charge 1 by 12. Every month where the amount of service will be how much? Every month we have to recognize. Is that we have to recognize. See, recognize the component of service element in the performance obligation. Yeah, in the performance obligation. This is the point where we are very much concerned about it, and this is the point where we have to understand what we are doing as such. Okay, that is the reason what they have said. They said the revenue is going to be how much? 10. 120 divided by 1 by 12 from the means every month you are providing the service, you are charging for 1 full year service. Is that we don't know what will happen. There will be an uncertainty element will be there. Is that in order to avoid, that is the reason what we are doing. We are covering various different things. There is a uncertainty element. One thing, there is a concept of prudence. We have to be very conservative. Is that we have to be very conservative. We should not be very aggressive. Okay, we have to be very conservative, proportionately, and most importantly, see the things we cover. We can understand the concept. May have the concept of matching concept. See, as a student of SBR, we have all these things in our mind. Okay, as a student of the SBR, see what they have mentioned. The exam is unlikely to apply all 5 steps. Nobody will ask all 5 steps. But exam question will most likely to ask 1 or 2 of these steps. Few marks are awarded for knowledge and will be instead of awarding for application. Because see the thing, most important thing is theoretically also you have to be very sound. Okay, theoretically you have to be very sound. Then only you can make applications. Okay, that is the reasons students find little bit difficult. I will advise you, I will suggest you, I will recommend that first you should cover the study text. Once you have studied with test your understanding, automatically you can do the exam kit very easily. Okay? Now what they say, first we are doing, see, we'll take one step, we'll follow the example. Is it right? IFRS 15 says that contract is agreement between two parties that creates rights and obligation. A contract does not need to be returned. Is right? An entity can only account for revenue for the contract. Follow. What are the conditions? The parties have approved the contract. Means it is every contract is, we cannot say that every contract should be in writing. Okay, in most of the cases it not happen, but there should be understanding. Approval have to be there. Each party rights have what I am selling, you are buying. You should have clear-cut rights and obligations. Payments terms should be identified, how we are going to pay, and there should be a commercial contract has commercial substance. That it is from the perspective of profits. Okay, it is probable that the entity will be paid. Yeah, the commercial substance means there should be a monetary aspect should be linked to it. What it says that Aluna has a year in 31st December. On 30th September, Aluna signed a contract with a customer to provide them with an asset. They have signed the contract, is it right? They have signed a contract. Control will be passed to the customer on 31st. The customer will be paid, is that? By 31st December, as a result of changes in economic climate, Aruna did not believe it was probable that it will collect the consideration that it was entitled. See, what they say, the rule says that, what are the 5 steps? The 5 steps say that it has to be a recognized revenue, a performance obligation is satisfied. Is it? Performance obligation is satisfied. Here what's happening? Definitely everything is there. You have a contract, but performance obligation is not. It was probable that, it was probable that it will collect the consideration that it was entitled. Yeah? Aruna did not believe it was probable that it will collect the consideration. They say did not believe, means definitely we are not going to satisfy. Therefore, the contract cannot be accounted, as there is no revenue should be recognized. See, when they say that it is not going to collect the consideration, if it is not going to collect the consideration, what will happen? Definitely, if there is no consideration, it is not going to be identified as a contract. Okay, these are the basic things. You should have a performance obligation, separate promises transferred or the goods or services. Some contracts contain more than one performance. How it will be? We are not only selling a car. It includes what? We are most of the time, we are having they will say, we are selling the car with 2 years service, free service. Is that 2 years free service? Is that we are selling a car with free insurance? Is it right? We are selling a car with a free insurance. We are selling a car with a free registration. Likewise, you will have the thing. Means you are not selling one product, but you are selling supporting things also. And then it is a more than one performance obligation. An entity might enter into contact with the customer to provide 5 lectures, okay, as well as to provide a textbook. Then we are not only provide. See, it's happening nowadays. Very, very simple. They say that we are going to give the books free of cost. Is it right? If you get registered, is it registration free? Is it? You will have a free registration. You will have the free books. Is that you have the free books? Like that, you will have the free classes will be there. Is that you will have the, if you say that register before this date, is that before that, you will get some complimentary offers will be there. Fine. If that is the case, then we are doing there is nothing free of cost. There is no free lunches as such. Everything, everywhere, it has to be chargeable. Distinct performance obligation within the contract must be identified. What we are doing, what we are performing, what we are delivering. Is that what is going to be delivered? Is that you have to be very, very specific. When within a contract, a promised goods or service, a customer can benefit from goods or services by using, as simple as possible. There is a cost benefit, is it right? When you are paying something, definitely we will expect that it has to be compensated. The promise to provide service is separately identified from other contractual promises. We have to promise to provide services as such, okay, apart from what has been stated. This means what is the revenue? The most important thing is the performance matters, is it right? If the performance is there, then only it will be paid. If there is no performance, there is no payments. Now identify performance. What happens? Starling entered a contract to build a school for one of his customers. Fine. They fulfill the contract. Starling must provide services such as clearing the site, foundation, procuring the materials, construction, so on and so forth. Is it? Now, what the customer can benefit from each of these services individually, evidence from the fact that these services could be purchased separately from range of entities. Means what now it's very what we are doing. See the thing we are talking in terms of a concept called as BPO. Is it business process outsourcing? My handwriting is not that much good. Okay, we are going to see what we will take everything. We are asking them to provide from things A to Z. Is it right? Everything should be provided to us. Fine. That is the case. You can take it individually also, but you have the option to take it as a package also. However, these services are not separately identified because Starling is being contracted to significantly integrate them into identify output as a school. You want that, see if you do go, these things are not separately identified because you want all are integrated. You are making a construction, is it? You are making a construction, definitely to build a school, definitely it doesn't need, we cannot work as a stand alone. Is it? Stand alone activity is not possible. As a starting accounts for all the promised goods as a single, this if you put all the things into a one consideration, the same performance obligation will be identified as a one unit. Is it? This is again a very significant thing. Principals are agents. See what happens. An entity must decide the nature of each performance. See, these are the things. See, we don't need this to remember, but keep it in mind. Very important. This is what I will suggest. Whenever there is bold, is it? Whenever it is written, wherever, is it right? I will put wherever it is given in bold. Is it? That much you can these things you have to revise it. Is it? Either at the time of revision or before going to exam. Okay, at the time of revision. To what it says, to provide specific goods or services itself, that is, it is the principle. And to arrange for another party to provide goods or services, it is an agent. You have to provide goods, specific goods or services itself. It's a principle. And if you are arranging the things for somebody else, then it is an identified as an agent. Entity is the principal who is providing the goods or service before it is transferred to the buyer. If the entity is an agent, revenue is based on the fee. Is that very important? I will explain you like this. If you are a principal, is it right? If you are a principal, there is no middleman. Okay, you are directly providing the goods and services. But what will happen? You are providing goods and services directly to the customer. If what happens, you have a principal, and in most of the cases you will have, in between you will have an agent, then you will have a customer. Is it? Then you will have the customer. What happens? Here the principal will charge 100, customer will pay 100. Here the principal will charge 100. This is for him sale. Agent will charge 10, customer will pay 110. Then you have to divide. 100 is the sales of principal, revenue for the principal, and 10 is the revenue for the agent. That's the way. That is where we have to see. Contracts is very happen. You will have main contractor, you will have subcontractor, you will have subcontractor. The link, there will be so many different levels will be there. Is it right? You will have one main contractor. Fine, one main contractor. This main contractor will give things to you will have subcontractors. You have subcontractors at different levels. Again, what will happen? Definitely, the at every level there will be every subcontractor will have its revenue in the form of fees. That's the most important thing to be understood. Is it? Now, else for you operate a website that enables customer to purchase equipment from range of suppliers. The supplier deliver the goods directly to the customers. When the good is purchased via the website, they will earn a commission at the rate of how much? 8%. Sale prices are set by whom? Sale prices are set by the supplier. Customers pay when they place the order. All orders are non-refundable. Once you have ordered, it is done. Okay. OWLS is an agent because it does not. OWLS for you is an agent. What it says, they operate a website that enables customer to purchase computers equipment from a range of suppliers. Is right? Now you have, most of the time you have online buying. Is it right? When you are talking about online, Amazon, what Amazon is doing? Amazon is doing the same thing. Is it right? Amazon is doing, you are as a customer, you will place the order, and Amazon will have the network with so many different suppliers in every country, and automatically those suppliers will supply the product. That's what it's saying. OWLS earns nowadays. If you see the Instagram, is it right? If you see, most of the people are doing the same business. Is it right? They appoint agents in different countries, and they will start doing the business. They get a commission of 8% on the sales. OWLS is an agent because it does not control the computer. If you have control over the ownership on the asset, then you will have principal. If you don't have a ownership on the asset, then it is going to be an agent. Control belongs to the supplier who set the prices for goods, and who is responsible for the, means now you can say as an agent, deals for you will recognize revenue based. What is the commission? What is the revenue for you? The revenue for you is only 8%. Okay, the revenue is only how much? Whatever the commission you are getting, that is revenue for you. Got my point? This is what the concept says. Means you have to make sure that how happening. Another most important thing, warranties. We will say whenever you are buying a product, when you are buying a gadget, any gadget you are buying, what they will do, they say that this is the value of the product. With one product, they say that free 1 year warranty. They will say 1 year warranty. So it is not free. Okay, don't say it's a free. We will do this in the next few slides. Okay, next few pages. It's not free. They will say that you can buy. You can buy a 1 year extended warranty. You can buy 1 year extended warranty. Means, get my point? Now, when you are saying it's extended warranty, see the thing. Most of the time, a warranty is an assurance. That's all. Product will function as intended. In this case, if this is the case, then the warranty will be accounted. See, it may or may not be. Is that may or may not be? Is that may not be? See, warranties is, see, previously they used to have a guarantee. Now they have removed the guarantee word. They replace it the warranty. Where it counts, it comes under the category of in accordance with IAS 37 provisions, contingent liabilities and contingent assets. How we have to treat the warranties. That's very important. Is that, see, if you're covering IFRS 15 this lecture completely, automatically you are thorough with the concepts. If the customer has the option to purchase warranty separately, then we means what? The product is different, the warranty is different. There is a distinct performance. I don't want warranty for my product, I will not pay. But if the moment I wish to opt for a warranty, then it is a very specific distinct performance. This means that the portion of that transaction price must be allocated. You have to allocate the value of the product. You have to allocate, we have done with respect to services, and also we have to think in terms of warranties. Now we have added another one, is it right? The value of product is 300, value of service is 120. Assume value of the warranty is how much? 60. Is it? That is the second distinct performance. Determine the transaction price. The price has to be determined. If there is no transaction price, we are not supposed to work out on in any way. IFRS 15 defines the transaction price. Has to be there. It has to be an inbuilt criteria. Consideration of entity in terms of exchange for performance obligation. Everywhere, at every stage, they are using this word repeatedly. Performance obligation. And sale tax is what every point of time. Please, why we have to exclude sale tax? Because it is given to the government. You talk about sale tax or you talk about value added tax. Value added tax is not, is it getting my point? We have done it in taxation. Is it right? If it is included or if it is excluded. Is it right? If it is included, means value of the product is how much? 100 plus 20. If it is excluded, then the value of the product is not going to be part of the product price. Is it right? This is entirely belongs to whom? Belongs to the government. So whenever we are talking in terms of revenue, there is a basic understanding that tax should be excluded. When determining the transaction price, what are the conditions? It should be variable consideration, means according to the number of units. It should have financing components, monetary value, non-cash consideration. Is a non-cash consideration, and over and that consideration is payable to the means if you take into consideration, in other words, there should be a monetary element attached to it. Variable consideration, when we are talking about the variable consideration, if you want it, we will opt for it. If we don't want, as simple as that. You order more, you have to pay more. Is it right? You order customized products, you have to pay as per your customization. Is it? Where entity must estimate the amount. What IFRS says, again, bold letters can only be included in the transaction if it is highly probable that significant reversal in the amount of the transaction will not occur. Is it? What it says, the significant, that is the basic thing, is it? Whenever we are selling the goods, you can see nobody in the world nowadays, when you there are some instances, okay, I'm not saying about, there are some instances where there will be a refundable. But whenever there is a refundable, is it right? If you are paying $100, if it is refundable, you will not get complete 1,000 to 1,000. They will refund with some deductions. Is it? This has to be part of the agreement terms and conditions whenever we are thinking about a variable consideration. High probable that a significant reversal in the amount of cumulative revenue recognized will not occur when there is a uncertainty. They gave you a small question here, is it? On 1st December 2001, Bristow provides a service to the customer for the next 12 months. The consideration is 12 million. Bristow is entitled to extra 3 million if after 12 months the number of mistakes fall below a certain threshold. See, they are providing the service very, very interesting, very conceptually. See the thing. They are providing the service to the customer for 12 months. Fine. Now, the consideration is how much? For 12 months, the consideration is 12 million. Now, if there are no errors, no mistakes, is it right? If there are no mistakes, they are going to have how much? He is going to entitled how much? 3 million. Means how much he will get? 15 million. This is for how much? This is for 12 months. If you take it for 1 month, 15 by 12, it comes to how much? 1.25 million. If there are no mistakes, is it right? I will write here in point number A. Is it right? I will write here in point number A. Is it? If assume you are having a contract like this, there is a fixed consideration. Is it right? How much is the fixed consideration? Fixed consideration is 12 million. Is it right? And there is a variable consideration, is it right? The consideration they are entitled to an extra 12 months, is it? There is a consideration with respect to consideration based on the mistakes, is it right? Okay. If there are mistakes less than threshold, is it right? Less than threshold limit. How much is there? 3 million. Is it? It is how much is it? It is going to be 3 million. Right? Now, how much is the total consideration? If you take into consideration what is the transaction price? Transaction price is how much? Transaction price is 15 million. Is it right? Transaction price is how much? 15 million. Now, they are saying that is going to be performance, so is it 15 million. 15 million for how much? 15 million for 12 months. What they are saying? Discuss the accounting treatment above Bristow's financial statement for the year 31st December. See, when they have started it for 1st December. Is it right? They have taken it in the 1st December. Means we have to calculate. Is it right? We have to calculate for 1 month. Because it is from 1st December 2001 to 31st December 2001 for only 1 month. For only 1 month. $15 million multiplied by 1 by 12. Is it? 15 million by 1 by 12 as such. It comes to how much? How much is the amount? 1.25 million. Bristow has experience in providing identical services, and it is highly probable that the number of mistakes made will fall below the acceptable level. If it is falling below acceptable level, how much for the 1 month? See, make it sure it is from 1st December to 31st December. Okay, 1st December to 31st December. How much is the? It is going to be 1.25 million. Next. Bristow has no experience of providing this service and is unsure if the number of mistakes made will fall below. There is a point where he is unsure whether things will be. He doesn't have any idea about the things. Then in that case, is it right? What is the transaction price? Transaction price is going to be how much? Transaction price is going to be 12 million. Is it right? And for what is the for 1 month from 1/12/2001 to 31/12/2001. If for 1 month how much? For 1 month it will be 12 million. 12 million divided by 12 months. 12 million. 12 million. 12 million. Why? 1/12. It comes to how much? 1. This is for where? If they say that they are unsure about the number of mistakes, definitely they know that maybe the mistakes will go beyond the threshold limit. If the mistakes go beyond threshold limit, definitely they will think about only the fixed component but not the variable component. Okay. Note that if the product is sold with a right to return, then the consideration is variable. If the product is sold with a right to return, definitely it is variable. The entity must estimate the. See, you have to know what is the fixed consideration, what is the variable consideration. If there is a terms and condition that it can be returnable, then we have to be very cautious in working on that component as such. What it says, the second one. Okay. Norton enters 50 contracts with customers. Each contract includes how much? Price is 1,000. The cost of Norton is how much? 400. See, what is the sale value? Sale price is how much? Sale price is 1,000. Cost is how much? Cost is 400. Cash is received upfront and control of the product transfers on delivery. Customers can return the product within 30 days to receive the full refund. Norton can sell the returned products at a profit. Fine. Norton has a significant experience in estimating the return. How many? They say that it estimated that 48 products will not be returned. Means 48 products will be sold and only 2 products will be returned. Is it? This is ACCA, SBR. Okay. Please subscribe to my channel, share this channel, and write your comments. Okay. Comments. I am very slow. Write your comments, and till the end, if you like it, press the like button. Okay. Thank you so much. Now coming back to this, what they say, how much is there? See, they are talking about now what is the sale price? Very simple. Sale price is how much? Sale price is write down for estimated sales. Is that estimated? Estimated. How much is there? It is 1,000 times 48. It comes to how much? 48,000. Fine. That's okay. Fine. Now the thing is, what we have to think is about refund liability. we have to take into consideration the refund liability of the with respect to Northern. Okay, the refund liability is related to whom? It related to two products, estimated two products to be returned. How much is there? 1000 times 2, it comes to how much? 2000. It shall to be recognized. Yeah? Refund liability to be recognized. When it is a refund liability, what you have to do? You have to recognize the component of its cost also. Is it right? You have to, what is the corresponding credit cost of sales? Is it right? Is that what is the? We have to de-recognize the inventory. Is right? We have to de-recognize the inventory cost. Is it? How much is the? See, what is the cost? Cost is 400. Okay. How many products are there? 2 products are there. It comes to how much? It comes to 800. That is, see, that's what we say. What we'll do, we'll take it is as a sales minus cost of sales. Is that? You will get gross profit. You people are SBR. You have done all these things. Is that? You are expert in this. Fine. That is why how we are doing. We have to identify what? We have to identify the refund liability. Is it? This means how much you have sold. Okay. Now coming back to this, in determining the transaction, entity must consider the timing in terms of finance of payments to the provides the customer if that entity has that financing benefit. If you are talking in terms of financial benefit, is it right? Definitely we will see when you are going to pay. Sometimes what will happen, they will pay after 1 year, they will pay after 2 years, they will pay after 3 years. Is it? Definitely. If that is the case, we have to be very cautious in taking the time value of money. So time value of money, present value, we have to calculate. IS provide following indications. Is right? The difference between the amount promised consideration and the selling price. There will be a promised consideration, how much you are going to pay and what is the selling price. Definitely there will be a difference. The length of time transfer means you are paying after 2 years, after 3 years, after 6 months. Usually what will happen, see what will happen, there will be 0 days to 90 days credit. Normal circumstances. Okay. Normal circumstances. Then what happens? See, as per the rule, is it right? There is a time value of money. Is it? There is a time value of money. Based on the time value of money, we have to consider. We can sale price will be how much? Sale price will be 100. But after 90 days, if you convert into time value of money, the value of money will be how much? Assume it at the rate of 10% only, it will become how much? 90.9. Then we say what is the value of the money at the time of payment. Based on that, we will fix the selling price. If there is a financing component, then the consideration for receivables needs to be discounted to the present value. Very, very important. Fine. Now, Root enters into a contract with the customer to sell equipment on 30. See, dates are very important. I always stress in my videos, dates are very, very important. Control of the equipment transferred to customer as on that. The price stated is how much? The price is 1 million. And when it is going to be due? It is going to be due on 31st December 2003. How many days are there? If you take into consideration, it will be how many? It will be 2 years. It will be how much? Market rates available for this particular. Explain how this contract should be accounted for financial statements for the year ended 31st December 2001. They have given you, see the thing, the price of the contract is 1 million due on 31. Market rates available for particular customer is how much? It is nothing but, in simple terms, it is a present value. Okay, it is a discount. We have to take into consideration the length of the time between the control and the time between. Is it a time between is it time between transfer of control, time between transfer control and payment date. How much is they're talking about the, see, it is nothing but the discount rate. Okay, it is nothing but the discount rate. This is nothing but the value of C. Is it? What is the present value? Present value is C divided by 1 plus R to the power of T. Is it? How C is how much? C is 1 million. R is how much? 10%. T is how much? 2 years. If you take 1 million divided by 1.10 to the power of 2, is it right? To the power of 2, it comes to how much? It comes to 826, 446. Is it right? It comes to how much? 826. This is the how the transaction should be reflected as on 31st December 2001. Okay. Now, non-cash consideration. Any non-cash consideration is measured at the fair value. How the non-cash consideration is there? Keep it in mind. Yeah, again, is that if the fair value of non-cash consideration cannot be an estimate liability, then transaction is measured during a standalone selling price only. If it is not going to be taken, cash is not related, then you have to take the selling price only. That you have to, you should not assume whatever is there. We have to be realistic in that. Dan sold a good to control over the goods was transferred on, when it has been transferred, 1st January 2001. See, in the examination you will get, see, you are expert, and is that you have done computer based examination. Again, I will tell you, wherever it is there, just highlight the things. It will be easy for you. The consideration received is how much? 1000 shares. What is the fair value? Is 4. Is it? How much is the fair value? Now, how much you have to recognize? Revenue recognized. By 31st December, these sale instant have fair value of 31st December. Definitely the value of the shares will increase or decrease. Okay, the value. How much revenue should be recognized from this transaction in financial statements for 31st December 2021? It has been happened on 1st January, 31st December. Is it? Non-cash consideration, if it is there, is it? If it cannot be, if the fair value of non-cash consideration cannot be estimated reliably, then transaction is measured with the standalone selling price of goods and services. We have to see the standalone selling price. We cannot reliably measure that it will be share value. It's all estimates. Okay, it's all estimate. Now, how much is the revenue we have to recognize? Revenue is 1000 shares times $4. Is it right? We can recognize as per IFRS 15, we can recognize how much? 4,000. But instead accounted for in accordance, see, we can use, is that IFRS 9, is that IFRS 9, financial instruments. It is too early to explain this, but I will explain you as it is needed. As per IFRS 9 financial instruments, what we can do, we can we can account it. Is it? We can account. This means you can understand if it is going to be identified, then only we have to take that into consideration. If it is not, then we cannot assume and presume, and it could be consideration payable to the customer. If the every concept is supported with small test your understanding. Is that very important? If consideration is paid to the customer in exchange of a distinct goods or services, then it has going to be counted as a purchase transaction. Assume that the consideration paid to customer is not in exchange for a distinct goods or service. If it is paid for a distinct goods and services, then it has to be for a purchase transaction. It is not in exchange of goods services. Is it? Then what we have to do? We have to do appropriate adjustments before it is going to be reflected. What it says, understand the thing. Golden Gate enters into a contract with a major chain of retail stores. The customer commission is to buy how much? At least 20 million of products over the next 12 months. The terms of the contract require Golden Gate to make a payment of how much? 1 million to compensate the customer for changes that it needs to make to its retail stores to accommodate the product. See what is happening? You are paying how much? You are paying 20 million for the products for the next 12 months. The terms of the contract is to make 1 million to compensate. Fine, good. That's very interesting. By 31st December, Golden Gate transferred products are how much? They have transferred products of 4 million only. If it is transferred from 4 million only, we have to do it on a pro rata basis. We have to do it on a pro rata basis. Now, what is the transaction price? Original transaction. How much? 20 million products. Is it? We'll say the transaction price is how much? Transaction price is how much? Transaction price is 20 million. How much they are paying to make changes to the retail stores? Is that they are paying something now to make changes in the retail stores. Changes in retail stores is how much? They are paying 1 million. Is it right? 1 million means what is the amount? It is 19 million. Percentage of reduction is that 1 million divided by 20 million. Is that 1 million divided by 20 million? How much will come? 1 divided by 20, it comes to 0.05 or 5%. Okay, 5%. Now, how much he received on 31st December? 31st December, Gold transferred products of how much? Sales value is how much? 4 million. Is it right? 31st December. Sales value is how much? Sales value is 4 million. Again on 4 million minus, okay, 1 minus 0.05. Is it right? Is that? We have to take the net value, okay? 4 in times 0.95. Is it right? 4 times 0.95 means how much the revenue to be recognized revenue to be recognized is how much? Revenue to be recognized will be 3.8 million, proportionately to the amount of sales. Definitely the contract is for 20 million products. Is that 1 million will be compensated? Is that 1 will be compensated? Now we have not done 20 million sales. The turnover is only to 4 million. On the 4 million, they will pay 3.8 million. This much revenue should be recognized as per IFRS 50. Is that as per IFRS 50? Okay. Fine. Just to go through these things. In the next session, we will continue from the step 4. Okay. Thank you so much. Subscribe to this channel, share this channel, and if possible, like this channel. Thank you so much.